Hello class, this is a video lecture for Chapter 11, which is called Corporate Reporting and Analysis. It really focuses on the last part of the balance sheet, which is stockholders' equity. So there is a lot of different accounts to talk about. This is our chapter preview. I will skim through the features of corporations. You will be able to study it on your own. We will have journal entries for issuing common stock of 3 different types. Then we will talk about cash dividends versus stock dividends, and we will have 2 journal entries for each. And then we will briefly mention stock splits because they do not require any journal entries. We'll talk about preferred stock and how to calculate preferred dividends. Then we will look at treasury stocks and 3 types of journal transactions. I will skip reporting equity. You can read on it in the textbook. And then the chapter finishes up with 4 different ratios related to this information. So characteristics of corporation, I'm just going to go through this. You will be asked to answer multiple choice questions in the quiz and as well as on the test about it. So this is the structure of the corporation. These are advantages and disadvantages of corporations. This is the incorporation process, the corporate charter, and shares of stock. And also these are 5 rights to common stockholders. They all have a right to vote, to sell stock. They have a preemptive right, which means if there are additional shares issued, they have a right to purchase them first. They have a right to receive dividends if any are paid out, and they have a right to share equally in any assets remaining after creditors are paid if the company is liquidated. So there are privately held corporations and public corporations. We're mostly covering public corporations in this class. And so this is from chapter 1, right? So we're talking about equity, and equity includes 2 components. So one component is capital that is paid in by the investors. So this is, we used to talk about it just with one account, common stock. In reality, there will be common stock and preferred stock and treasury stock, and this new account with a loan name paid in capital in excess of par. So this is a group of capital coming to our company from investors. So this group is called paid in capital or contributed capital. The second part, I like you to think of it as earned capital. So capital is contributed, paid into the business, and then we take this capital, cash and other assets, and we start earning revenues, incurring expenses, and then paying dividends. Together, it's called retained earnings. This is just one account here, retained earnings minus plus. So revenues increase retained earnings, expenses, dividends will decrease it. But I also want you to think of retained earnings as an earned capital. So contributed by the investors versus earned by the operations. So basics of capital stock. First of all, we need to know the differences between authorized shares, issued shares, and outstanding shares. So authorized shares are not a total number of shares that the corporate charter authorizes us to sell. So we usually do not issue all of the shares at the same time. So this authorized number is the total maximum we can ever issue. And then issued shares is how many out of these 250 million shares, how many we actually issued. If we ever buy shares back, this will be called treasury stock, or it's sometimes referred to as buybacks. So often companies issue shares at one point, and then for many different reasons, companies buy their own shares back. We call it in accounting treasury stock. So if the company ever bought back its own shares, then number of issued shares minus treasury stock, minus what the shares the company purchased, will be equal to outstanding shares. So outstanding shares is the actual number of shares right now in circulation, being outstanding, being held by our owners, our investors. If the company, like in this example, there is no treasury stock. So if there is no treasury stock, the number of issued and outstanding shares is the same. So let's take a look at journal entries for issuing shares, right? So we will have to have two different examples for stocks with par value versus for stocks with no par value. Now, stated value, the journal entries are the same as par value. So par value is an arbitrary amount. It has nothing to do with market price. Usually it's a very small amount. It's like 1 cent or less than 1 cent. If you look at Pepsi, it's like 0.001 cent. So market price is the price at which you can buy shares at the stock exchanges. Par value, I want you to think about it. It's a very arbitrary amount. So if the company sells a share for $100, its par value, let's say, is 1 cent. So the company can use $99.99 for whatever operations they want. But the par value, that 1 cent, the state law obliges the corporation not to use it up. So in case the company goes bankrupt, the company is supposed to pay that 1 cent, only 1 cent, only the par value back to the investor. So some states allow for no par value stocks. Most states require par value. So it depends where the corporation is incorporated. So for par value, this is how we journalize it. So the company issued 30,000 shares, $10 par value, $12 per share. That's market. That's market. Again, usually par value is not that high. Usually it's much lower. So the company gets cash. If you look at cash right here, right? Cash is the number of shares multiplied by market price. This is our debit. We receive cash. You have two accounts to credit. Now, we didn't study it before. In all previous chapters, when we talked about common stock, we just said credit common stock. In reality, if it's a par value stock, you have to credit two accounts. You have to credit common stock at par, right? So common stock is $10 multiplied by 30,000 shares. So that's at par. And then the rest of it, so like $10 par value, $12 market price. So the excess is $2 per share, and we issued 30,000 shares. So, or it's just a plug-in. It goes into this account, which is called excess. I just like to refer to it as excess, or paid in capital in excess of par value. So these are your two credits. And so if you look at the stockholders equity section, you can see both accounts right here. They are both equity accounts. They are both part of the contributed or paid in capital. No par value stock has just one debit, one credit. There's no par value. This is how we talked about it in chapters 1 and 2 and 3. Just debit cash and credit common stock. There is no excess account. Okay. You also sometimes can issue stock for non-cash assets. So here is an example where instead of paying for land, we're actually exchanging shares, right? The asset is land, it's valued at $105,000. We are giving 4,000 shares with $20 par value. So instead of debiting cash, we debit land. Your credits are recorded in the same manner as I explained before. So this was issuing stock. Now, dividends. There are two types of dividends. We've talked about cash dividends before. And you can see here that 75% of corporation paying dividends on common stock. So 25% never pay stock. Some companies have never paid dividends, right? If you look at Amazon or Netflix or Google, which is Alphabet, those companies do not pay dividends. But if the company decides to pay cash dividends, there is actually 3 dates. So there is a date of declaration. Today I declare that everybody who is on record for March 1st will get paid on June 1st. So these are 3 different dates. The date of record does not require journal entry, but the date of declaration, when I just declare that I will pay dividends, it creates a liability. And then on the date of payment, I pay off the liability. So with the cash dividend, again, here is an example. January 9th, we declare a $1 per share cash dividend on 5,000 common shares. So each share receives $1. So we declare, instead of debiting dividends, that's what we did in chapter 1, we're gonna directly decrease debit retained earnings. So then we don't have to have a separate account dividends. I want to remind you that, retained earnings is minus plus, and so when we debit retained earnings, it goes as a negative because a dividend decreases retained earnings, right? It's the cash flow out of our company back to our stockholders. And guys, it's not credit to cash because I just make a declaration. So this is a new account. It's a liability account. Goes up. Liabilities are minus plus. Common dividend payable goes up. On the date of record, which is January 22nd, there is no journal entry, and we are paying on February 1st, so the liability is just paid out. So the liability goes down, cash goes down. The second type of dividend is a little bit more complicated and doesn't happen as often. So instead of giving cash to our stockholders, we're giving them additional shares of stock. So these are reasons why companies issue stock dividend. There are two types of stock dividend, small stock dividend and large. I'm not going to ask you questions about the large stock dividend. So just focus on small stock dividend, which means a distribution is equal or less than 25% of all outstanding shares. So guys, we are not giving cash. We're just simply capitalizing retained earnings. We're taking funds, the amounts out of retained earnings. So retained earnings will go down, and we're moving them to common stock to paid in capital. Common stock and excess account, they go up. So an important part here is that since there is no cash, no assets are impacted, the total equity does not change. When we issue small stock dividend or any kind of stock dividend, total equity does not change. The total equity remains the same. It's just that retained earnings decrease and the paid in capital increases. We redistribute equity. We capitalize, we move retained earnings into the paid in capital. So here are examples here of the journal transactions you'll have to make. We have 10,000 shares at $10 par value. We declare 10% stock dividend, so it's a small stock dividend, when the stock was selling for $15 per share. So this is market price, this is par. And the stock will be distributed to stockholders on January 20th. So on December 31st, we make a declaration. So again, 15,000, that's market price, right? Retained earnings goes down. That's a declaration. $15 multiplied by 10% of 10,000 shares, which is 1,000 shares. So 1,000 additional shares will be issued. So after this declaration, the company will have 11,000 outstanding shares. And 2 credits go to these accounts, right? So instead of, this is a brand new account, it's called common stock dividend distributable, because we're not giving shares of stock right away. This is December 31st. We will actually distribute shares of stock on January 20th. So we have to credit this account. It looks like a liability, but the word distributable makes it actually an equity account. It's a regular equity account. And this one is credited at par. So retained earnings are debited at market price. Common stock dividend distributable is credited at par. $10 par multiplied by 1,000 shares. And excess goes to the excess account. So I just want to make sure that you understand that before and after the stock dividend, the total amount does not change. But I will have less retained earnings. So right here, I had 35K of retained earnings. After stock dividend, I will have 20,000. So I take 15,000 and move them to total paid in capital. Paid in capital was 108 and now it's 123. So I moved from retained earnings into common stock, dividend distributable, and paid in capital in excess of par value. Both of those accounts are part of paid in capital. And then on January 20th, when I actually distribute shares of stock, I get rid of this dividend distributable account and I move it to common stock account. Okay, stock splits, guys, read on it. There's no really change there are no journal entries. It's just sometimes when shares of stock increase in price a lot, like Apple had to do it a few years ago. Their price was, I think, about $700 per share, which makes, a high price sometimes does not allow some investors to prevent some investors from buying our shares of stock. So Apple went through 7-to-1 stock split. So here is an example of a 1-to-2 stock split. A company had 100,000 shares, $10 per par value. Now they doubled the number of shares, but par value was decreased twice. So if I had 10 shares, now I'll have 20 shares. Par value changes and the number of shares changes, but there is no journal entry because the amounts do not change. Issuance of preferred stock. So some companies, 27% of them, in addition to common stock, they also issue preferred stock. So usually preferred stock, it's kind of similar to bonds. It has a stated dividend rate. So companies have to usually pay dividends to preferred stock. They cannot pay dividends to common stock until their obligations are fulfilled for preferred stock. But the other side of the coin here is that preferred stock usually doesn't have voting rights. So it's not real stock. You cannot vote. Most of the preferred stock is cumulative, meaning if we don't have dividends, if we don't have money to pay the declared dividend, again, it's usually going to be a specific stated percentage, like 10% of what? Of par value. So every year we guarantee that one share of preferred stock will get a specific dividend. If we don't have money to pay, then next year we will all double amount. So it's called dividends in arrears. It means that we must pay all dividends. It could be dividends in arrears, could be for 3 years. It means we did not pay dividends to preferred stockholders for 3 years. This is year 4, so we have to pay dividends for all 4 years before any other dividends could be paid to common stock. So theoretically, some preferred stock could be non-cumulative, but in reality, all of it is cumulative. And we will assume that all preferred stock is cumulative for all problems you do in your homework. So let me go right here. This is an example I came up with. So preferred stock has 9% dividend. It means, how do I find that dividend? It means that, let me go through this one. So 9% dividend means that we look at the par value of preferred stock. There is par value right here, $100. 9%, we multiply these two amounts. It means that every share of preferred stock is supposed to receive $9 of dividends. So there is 1,000 shares here, right? And let me change it right here. The board of directors declares 5,000 of dividends in 2021. In 2022, the board declares and pays cash dividends of $42,000. So the question is, how much of that amount, how much of 5,000 goes to preferred versus to common, and then how much of 42,000 goes to preferred versus common. So here is this information. So like I said, every share of preferred stock must be paid $9 of dividends per share. So annually, since I have 1,000 preferred shares outstanding, I have to fulfill $9,000 of obligations and dividends to them before common stock could be paid any dividends. So in 2021, the company only declared $5,000. So I cannot even pay the full $9,000, right? So I pay all $5,000 to preferred stock, and I record 4,000, keep in mind, not record, but I keep in mind that $4,000 are in arrears, meaning I owe it to my preferred stockholders. And so in 2021, common stockholders get no dividends. Next year, 2022, the board declares $42,000. So I have to pay my preferred stockholders $4,000 dividends in arrears for 2021, and I have to also pay $9,000 for 2022. So preferred stockholders right away out of $42,000, they have to get 13K. And whatever and the remainder, whatever remains, which is $29,000, goes to the common stockholders. So these are types of problem you will have for preferred stock, just to figure out how much dividend goes to both classes of shares of stock. There are no really journal entries here. And guys, the next topic is treasury stock, right? So you can see here that most businesses, most corporations have treasury stock. Again, financially, we call treasury stock buyback. The company often, for many different reasons, buys its own shares of stock and puts them in so-called treasury. So treasury stock actually is, I think, the only contra equity account. So if you think about treasury stock, it's a part of paid-in capital, but the signs are the opposite. So it's plus minus. It's a contra equity account. And so if you look at the company's balance sheets, treasury stock usually will be designated as a negative. The amount will be in parentheses. And this is very popular. And you can see many reasons here, many reasons. They're very important why companies buy their own shares of stock. One of the most important reasons is right here. The companies, if they're not doing that well and their net income is not growing compared to the previous year, a lot of investors look at just one most important ratio factor. It's called earnings per share, which I will give you a formula for at the end of this chapter. Earnings per share. So not total profit, not total net income, but pretty much net income divided over the number of shares outstanding. How much income, how much profit did every share make? So if the net income is not increasing or not changing, the company can artificially decrease the number of shares. How do they do it? Well, they take it out of circulation. They buy their own shares of stock, so their earnings per share looks higher, even though they actually did not make more net income. And there are other reasons here, right? So we need to know journal transactions. Right here, we make a purchase of our own stock. We buy 1,000 shares of stock in the open market. This is the market price. Now, this becomes our cost. This $11.50 per share. This is our cost. We have to remember this. So what are my transactions? I debit treasury stock. Remember, treasury stock goes up, which makes equity go down. It's a contra equity account, and we pay cash for it. So later we sell treasury stock. We can retire it, by the way, or we can later sell it. We can sell it at the same cost as what we paid for, right? So again, initially we bought 100 shares. Initially we bought 1,000 shares. And then later in May, we sell 100 shares. And guys, because the market price did not change, we just reverse it. We receive cash, we decrease treasury stock. What we want to make money on this, right? So in June, we sell additional 400 shares, but now the market price went up from $11.50 to $12 per share. So I receive cash of 4,800, which is simply market price multiplied by number of shares. But I record treasury stock at cost, right? So it's 400 shares that I sold at 11.50. 11.50 was my original price, original cost. So I told you to remember it, right? So if you take 400 shares multiplied by $11.50, you will get 4,600. The difference is the amount of money I made. We're not allowed to call it revenue because we didn't earn it. It's not coming from our operations, but it's money we made. So where does it go? It goes into this new account called paid-in capital treasury stock. So paid-in capital treasury stock. And it's minus plus. So when you make money, it goes up. What happens if we sell treasury stock below cost? Well, I don't want this to happen, but sometimes it does happen, right? So I want to remind you that paid-in capital treasury stock, paid-in capital treasury stock is the account which we just credited. So it's minus plus, and we credited it by $200, right? That was the amount of money we made. Well, what if we lose money, right? So right here in July, we sell 500 shares at $10 per share. So my original cost was $11.50, so I'm losing $1.50 on every share. So I receive cash of 5,000, but I have to credit treasury stock by at cost, right? So 500 shares multiplied by 11.50, this is where 57.50 comes from. And so I pretty much lost 750, right? So I would want to put 750 right in here into this account. But I am not allowed by GAAP to make this account negative. So paid in capital treasury stock has no impact on income statement. It's an equity account with normal credit balance, but if its balance cannot go below zero, so I only can decrease it by $200, make it zero, $200. Here it is, right? And then I still have 550 negative, the monies I lost. So I put it directly into retained earnings. Remember, when you debit retained earnings, it goes down. So this is an example of a transaction you will have in one of your homework problems. Okay, and the chapter concludes with ratios. So I mentioned earnings per share. This is the single most widely cited accounting statistics. Actually, any company's income statement includes earnings per share. I think it's the only ratio which is actually reported on the financial statement. So this is the actual formula, but like I said, the idea here is you take net income and you divide it over common shares outstanding. The higher EPS, the better the company is performing. It's making more net income, more profit per share. This is an interesting one. It's called PE ratio, price earnings ratio. You take market price per share, right? Look, today, how much is the share traded? And you divide it by earnings per share. How much does the market think the company's shares worth versus how much actual profit the company made? So here in general, if this ratio is very high, it's not good. It means the company's stock is overvalued. So price earnings ratio, when it's very high, and you can see companies, especially in the technological sector, the Silicon Valley companies, sometimes could have price earnings ratio of a few hundreds, 500, 600, meaning the market price is 500 higher than earnings per share. Versus the company with the lower price earnings ratio, 20 or less, that means everything being equal, the company is undervalued, so the shares of stock might be on the increase. So this is price earnings ratio. And then dividend yield, you take the amount of cash dividend divided by the market price per share, right? What percentage of market price does the company pay per year as a percentage in dividends? Of course, if you're interested in earning dividend, the higher yield is more attractive to many investors. Again, keep in mind that some of the most popular shares, such as Amazon, right, and I mentioned Google Alphabet, they do not pay any dividends. So it would say non-applicable, NA, when you look at the stock quote. And the last ratio is book value per common share. It reflects the value per share if the company is liquidated at balance sheet amounts. So right here is the formula. Well, that concludes chapter 11. Thank you so much.